Yo, most people think when you want to buy a property to fix and flip it, and it's not in good shape, you have to buy cash, but that is not correct. Check this out. Let's just say we want to buy a property and the purchase price is $150,000. And let's say it's going to take $50,000 to get this property renovated and ready to go. Now, let's just say you want to buy this property, make it a long-term hold. Right now, if you're buying it for $150,000, putting $50,000 in for renos, your total cost on this property is $200K. There's two things you got to look at. First is there's something called a hard money loan that'll get you to acquire this property. And the next is called the DSCR loan, which is going to allow you to refinance it into a 30-year mortgage and put a long-term tenant in there. When we're talking about hard money loans, usually there's two different terms you need to know. One is LTC, one is ARV. LTC stands for loan to cost. What is basically the ratio that is going to cost you to fix this to the loan? In this case, if it's going to cost $200,000 to acquire and fix, the lender usually, if you're a first-time investor, they're going to give you anywhere between 80 to 90% of the cost as a loan, and they're going to make you put down the rest. That means you're going to have to bring $40,000 to closing on this deal. They're going to finance a $50,000 reno. And now let's say when the property's finished, it's worth $300,000 as an example. Now, the second thing we look at, again, this one, the first was LTC. The second is ARV. What's the after repair value of the property? $300,000. Usually people will give you a loan, hard money lenders will go up to 75% of ARV. So basically they'll give you a loan up to 75% of $300,000, but not to exceed 80 to 90% of the cost. So let's just say again, 80%, you're putting 40 grand down. That's a loan left of 160 on this deal. What do you do now as an investor? You're going to refinance it into what we called a DSCR loan. A DSCR loan stands for debt service coverage ratio. It essentially just tells us as the lender that you can get an investor in the property or a tenant in the property that's going to cover the mortgage payments. As an example, let's say now this 160 loan, you're going to refinance it for 30 years on an 8% note. And let's just say the payments are around $2,000 a month. Well, what we're going to do is we want to verify, can you put a tenant in this home that can generate $2,000 a month in rent? If it can, the lender's going to give you the loan, plain and simple. And if it can't, the lender usually will still give you the loan because value of your home to the loan you're getting, the ratio is so low that they'll still give you the loan. However, the rate may be a little higher. But these are great options that a lot of people don't tap into. With DSCR loans also, it allows you to vest the property in the name of an LLC at closing, not deed it post-closing. When you do that, usually it won't even show up on your credit, which is phenomenal. Investors love it. If you guys have any questions, if you want to become a first-time investor, if you have questions on DSCR loans, feel free to shoot us a DM. We'd love to connect. Talk soon.